All right, on this module, we're going to be talking about multi-factor models. Just a quick recap on CAPM and an introduction to multi-factor model. I want to do a quick exercise here. Let's imagine two funds, right, A and B. This is all hypothetical, okay? And they invest in equities and treasury bills. So some sort of composition of equities and treasury bills or the risk-free asset, okay? And we analyze their performance, and we have shown here their means, their standard deviation, and their Sharpe ratios, okay? So let's just pen here. So clearly here, oh, and the question is which fund had the best performance? So if we look here, it's very clear that this one has higher average returns, although it has a higher risk, and the Sharpe ratio of fund A is actually better. So the risk reward ratio here is greater for fund A, but which one has the best performance? So clearly looking by the past data, we're looking at past data and asking which one performed more. Fund B had higher returns, right? So 0.6% here, that. However, did Fund B perform better because it picked best assets, or had a greater, like the management team picked better stocks, for instance, or assets in general, or it was just a matter of taking more risks, right? So maybe their returns were greater simply because their proportion invested in equities were greater than in Fund B, or sorry, in Fund A, right? So how to account for that? And to do that, we need to account for its risk, right? And if you remember from the CAPM, we can first see what beta tells us, right? So comparing to the market, actually Fund B has a higher beta. So like it is expected to have greater returns, right? Because it has greater sensitivity to the market, right? So it has a tilt to more equities. Therefore, it should have greater returns. So how are we going to analyze and figure out which one had the best performance here? So this, if you remember from the CAPM, the equation on CAPM to calculate the expected returns on this asset, the higher the beta, the higher should be the expected returns, right? So what we can do is run the CAPM regression analysis to find out alpha here, right? When you do that, we account for this difference in beta, and if CAPM holds, alpha should be 0. Clearly, it's not 0 over here. Both funds here outperform the market, but the thing is, when we adjust for this beta or the risk of Fund B, because it has a greater beta, we can say that because its beta is higher, it has a higher benchmark here to B. So therefore, this is why alpha on Fund B is slightly lower than Fund A, which makes Fund A actually have greater proportion of excess returns over the market than Fund B, right? Although clearly both outperform the market. However, we've got to remember the assumptions under CAPM that we are doing, right? First of all, we are assuming that all risk is embedded in beta, right? So everything that should yield different prices, or sorry, different returns, it's accounted just on beta. However, aren't there other like possible factors that influence returns, right? Can we actually use the sensitivity to the overall market as the only risk factor? And this is a question that came out early, a couple of decades ago, because they were seeing some anomalies in the market, some effects or factors that have shown to affect returns. And in the CAPM regression, they were embedded in beta, right? One of these factors that have shown to affect returns is the small firm effect, right? And basically here we have 10 portfolios sorted by size. So this is large stocks, this is small, and this is kind of on this side is increasing in size. in size. And we can see here from 1926 to nowadays, even after adjusting for beta, this is alphas, what you're seeing, clearly there is clearly here the low stocks, or sorry, the small stocks beat large stocks. So shouldn't we account for that, since it's already known that small stocks beat large stocks, right? And this effect actually was well documented in 1981. And this is the alphas before 1991. So clearly a very, very linear relationship here, kind of. However, after it was documented, it was incorporated in the market, and it's been mostly dissipated. But on average, as we saw here, there's still this residual effect of small firms outperforming large firms, right? Another known effect, it's the book called like the book to market effect. And basically here what Fama-French did in 2014, the same thing with the size portfolios. They made 10 different portfolios based on the book to market ratio, right? And if you guys remember, a higher book to market means value stocks or value, and a lower book to market or like more intangible goods compared to like tangible goods. It's usually related with tech stocks or growth stocks, right? And he showed that value stocks over the period of time outperformed growth stocks, right? So if you will use the CAPM regression to estimate their returns, they should be over here, right? However, you can see that portfolio 1, 2, 3, 4, 5, 6, 7, 8, 9, the returns were increasing as more value stocks were included in the portfolio, right? And that raises a question, right? Warren Buffett, non-value investors, should he be evaluated using CAPM equation, since it's known that value stocks outperformed growth stocks during that period, right? So this is how multi-factor models come and play a role, right? Multi-factor models, basically what it does is it says that expected returns of this asset over the risk-free asset, it's not solely dependent on beta, right? You try to break down risk factors, and you can think as many as you want here, but each risk factor has its own beta. And when you control for those factors, you might have a different alpha, right? So it's basically including multiple risk factors that might be present, instead of just putting everything under the beta, non-beta on the CAPM, okay? And by the way, those models have been proved to better predict prices than the CAPM model. Although we can also know that, I mean, give CAPM a break, kind of, because it's a very old model, right? And it's still widely used in corporate finance. There are some recent and more sophisticated models that have been shown to predict better prices. One very famous one, it was the Fama-French three-factor model, which was proposed in 1996. And it includes those factors that we were talking about. So size effects, book to market effects, and market effects. So basically, this is the CAPM equation, but it also controls for the fact that small stocks beat large stocks, and the fact that value stocks beat growth stocks, right? So the model that he proposed, you can think on that as the same as the CAPM, although with multi-variables over here. We can also include alpha in a literal term, and we can kind of analyze it using the same kind of logic, right? If this model holds, alpha should be 0, right? If you have an alpha greater than 0, it means excess returns. And if it has an alpha lower than 0, it means that this asset actually underperformed its benchmark, considering those non factors here that would impact its returns, right? And recent and other multi-factor models have been developed by Fama-French as well. and they can include other factors such as momentum, for instance, or liquidity or profitability. And there are other factors that can be included in that, but the logic behind is the same. You're kind of breaking down the risk component, which on CAPM would be just the beta compared to the market, excess returns to the risk-free market, and you are controlling for those known anomalies, let's say here in the market, to get your performance evaluation. And we're going to be doing a regression analysis using that model and comparing that to CAPM to see how the results changes and what other information it gives us.